Tesla stock will be worth $1,000 by the end of 2025. Before I get started in my analysis of the stock, just wanted to fully disclose that I own about $80,000 worth of the stock. So, just by that nature, it makes me biased. I also live in the suburbs of Southern California, and I see a bunch of Teslas driving around. Most people own single family homes, and they have garages where they can plug their Teslas into at night. So just by that nature too, by geography, also makes me biased. Even though I am a Tesla bull, I am not a hardcore fanboy though. There's a lot of things that I love about the stock, but there are a lot of things that I don't like too. For example, the stock has increased about 10x over the last 5 years. So the chance for crazy gains is no longer there. It's not going to be very realistic to expect the same type of growth moving forward. Another thing that I don't like about Tesla is that, unlike the automotive sector of the business, it is my opinion that the Tesla energy sector of the business will not play a dominant force in terms of the solar market and the stationary battery market. When it comes to Tesla Solar, Tesla does not have a competitive advantage when it comes to providing and installing solar panels. You can see this through the loss of market share since acquiring SolarCity back in 2016. When Tesla acquired SolarCity, SolarCity was the market leader in terms of market share. They were the number one spot. And now, 4 years later, Tesla Solar is in the number three spot in terms of market share. Yes, Tesla does have the solar roof, which is unique to Tesla, but the solar roof only makes sense if you are in the market for solar panels and you need your roof replaced. So the market is limited. Even if you meet that criteria, the cost of the solar roof actually is more expensive than the cost of replacing your roof plus adding solar panels, and it is less efficient than a solar panel system, meaning that the solar panel system will generate more electricity compared to that solar roof. In terms of Tesla stationary batteries, the Tesla Powerwall does seem to have a competitive advantage in terms of feature and price. However, the Tesla Powerwall right now, they are still cost prohibitive. I got a quote for a Tesla Powerwall, and it was $11,000 installed price for one Powerwall, which was 13.5 kilowatt hours, which means that it costs about $800 per kilowatt hour for that Powerwall. Just to give you an idea of how expensive that is, a Tesla Model 3 standard range goes for $38,000 and it has a 50 kilowatt hour battery. This means that that entire car sells for about $760 per kilowatt hour for an entire car. That car comes with autopilot. It has 8 cameras. It has an onboard computer. It has AC, heated seats, and it actually costs less in terms of dollars per kilowatt hour. Because the battery is so small and the price is so high, it leads me to believe that the battery for the Tesla Powerwall is only a small part in terms of the cost of the Powerwall, meaning that in the future, when battery prices come down, the price of the Powerwall will still remain relatively high, and it's not going to be a revolutionary product that's going to be in everybody's house. The real opportunity in terms of battery storage is in large scale grid level energy storage. As the grid becomes more renewable, uses more renewable resources, there's going to be an increasing need for large scale energy storage. The sun doesn't always shine, the wind doesn't always blow, and when those things don't happen, the grid is going to need batteries. The competitive advantage for the large battery, the Tesla Mega Pack, is unclear because The information is less known. That is a business to business sale rather than a business to consumer sale. And the information for that product is just harder to access. It's reasonable to assume that they do have a competitive advantage in terms of features and price. But even if they do, the competitive advantage is not going to be anything near the competitive advantage that they have in the auto industry. In the auto industry, their competitors are selling really a completely different product. Yes, it's a car, but their product is an internal combustion car, and Tesla is selling an electric car. When it comes to the competitors in terms of large scale energy storage, the technology is the same. They can just copy Tesla. It's not going to be completely super easy to copy Tesla, but it's going to be easier for the competition to just copy Tesla, which will hinder their ability to become a dominant force in that sector. The last thing that I don't like about Tesla is when the company talks about, or when analysts talk about, the autonomous driving network, the Tesla network, robo-taxi network. Autonomous driving will not really be a thing for a very long time, for at least 10 years, if not 20 years. And I believe this for two reasons. The first reason is that no matter how safe autonomous driving technology gets, it will always be safer to have a computer plus a human driver monitoring the computer behind the wheel. Regulators are not going to allow a complete autonomous network, a complete autonomous car, unless it becomes less safe to have a human behind the wheel. Even if autonomous software alone is super safe, let's say 10 times safer than a human driver alone, that might not be enough. If a human driver plus autonomous software is just even slightly better than autonomous software alone, then it's likely that regulators will not allow for a fully autonomous car. The second reason why I don't think the Tesla network, robo-taxi network, will become a thing for at least 10 to 20 years is that even if there are completely autonomous cars on the road, Tesla will have a very hard time competing with Uber. Uber already has a network of millions of drivers. Right now, when I request a Uber, I get a car with a driver in front of my house, usually in about 5 minutes. If I have to choose to wait 5 minutes for an Uber or 20 minutes for a Tesla, 9 times out of 10, I'm going to choose Uber. Autopilot is a great driver assist software. It is going to make Tesla a lot of money, but to expect an autonomous driving network of cars that will compete with Uber is unrealistic. Now that I talked about everything that I don't like about Tesla, let's talk about the things that I do like about Tesla. I like a lot of things about Tesla, but I'm going to make it quick. I'm going to sum up my entire bull thesis in one sentence. Electric vehicles will eventually take over the entire auto market, and Tesla will be the market leader. Allow me to expand on this. Electric vehicles are safer, more efficient, easier to maintain, cheaper to refuel, and eventually will cost less than internal combustion cars. Internal combustion cars have been around for over 100 years. The technology has matured, and there's not much room for improvement anymore. Despite being around for over 100 years and having all that technological development, let's look at how inefficient an internal combustion car is. When you store energy into your car in the form of gasoline, the engine uses the majority of that energy, about 68 to 72% of that energy, of which most of it is going to be lost through heat. And if you run that energy through the rest of your vehicle, by the time it gets to your wheels to power the car, only about 16 to 25% of that energy is used to move the car. Comparing this to electric vehicles, 69 to 73% of the energy stored in the batteries are used to power the wheels. And in addition, 17% of energy is recovered, adding to that figure, making it 86 to 90% efficient. And as technology gets better, that number will increase, making it close to 100% efficient. It's clear that electric vehicles are the superior technology, but right now, it is still more expensive to own an electric vehicle compared to an internal combustion car. It's debatable whether the total cost of ownership over the lifetime of the vehicle may be cheaper than an internal combustion car. But as battery prices come down, it will be increasingly clear that electric vehicles will be less expensive to own than internal combustion cars. It currently costs about $100 per kilowatt hour to create a battery pack that sits underneath the bottom of a Tesla in order to power the car. At about $90 per kilowatt hour, it becomes about the same cost to create an electric vehicle as it does to create an average internal combustion car. At around $60 per kilowatt hour, it becomes the same cost to create an electric vehicle as it does to create a economy internal combustion car like a Toyota Corolla or a Honda Civic. On Tesla Battery Day, Tesla outlined their plan to decrease their cost per kilowatt hour by 56%. This means that they'll be able to create a battery pack for less than $50 per kilowatt hour. This would make creating an electric vehicle cheaper to make compared to almost any internal combustion car in the market. So when this happens, we're going to see a large shift in consumer behavior because it'll be a no-brainer to purchase an electric vehicle. It'll be cheaper to own, more efficient, and have better performance. Tesla is currently dominating the electric vehicle market. In the US, they have 80% of the market share of electric vehicle sales. And the current car manufacturers, they just can't compete. They have structural issues within their organization that is just too hard to overcome. And as a result, Tesla is 5 years ahead of the competition in terms of battery technology, electric motor technology, driver assist technology, and manufacturing. And as long as they keep this lead, this large gap, they will continue to dominate the electric vehicle market and eventually the entire market. So, what does this mean in terms of stock price? How did I get my $1,000 prediction for the stock by the end of 2025? Well, to answer that question, I did some back of the napkin, really rough math in order to come up with why I think the stock will be worth $1,000 by the end of 2025. In this spreadsheet, I have what I think Tesla will be able to sell in the year 2025. In the columns, I have the car model, the number of units sold, the average sale price, and the corresponding revenue. So for the Model S and X, Tesla sells somewhere between 20 and 30,000 cars per year for the Model S and X. And I think this car pretty much reaches maturity at around 30,000 units per year, and it will sell around that much indefinitely. And for the Model 3 and the Model Y, Elon Musk had stated in the past that he thinks that the market for the Model 3 and Y are at about 1 million units each. So I have that there. I think it will reach maturity before 2025 or around 2025. So I think 1 million units is pretty reasonable. For the Roadster, it's their supercar, and it's not going to have a very big market. So I just put 3,000 units there. For the Tesla Semi, I put 50,000 units. In the US, about 800 to 900,000 heavy trucks are sold per year. So I don't think Tesla will have a huge market share in the semi market, but it will have some market share, and I think 50,000 is pretty reasonable. For the Cybertruck, I put that they will sell 400,000 Cybertrucks in the year 2025. And I got this by comparing it to the Ford F 150, which is the number one light truck seller in the US. And that sells about 900,000 units per year. I don't think it's going to do quite as well as the Ford F-150, but 400,000 units I think is a reasonable number. And then for what I call a Model 2, which is their 25,000 starting price, smaller car that they say will be announced in 3 years or so, I put that they will be able to deliver or make 200,000 units for their Model 2. The reason why I put $32,000 average sale price is, yeah, the price is going to start at 25,000, but most people are going to opt for the longer range, maybe performance, and most people are going to opt for autopilot. So I think a 32,000 average sale price is going to be pretty reasonable. And once this car comes out, it's going to be a $25,000 car, and that's going to really change consumer behavior dramatically. And I only have 200,000 units sold here because in 2025 they're only going to be starting to ramp up the production, I think. But I think the market for this smaller, 25K car, smaller car, is going to be in the multi millions of units, maybe 5 to 10 million units in the long run. So that's going to be a very huge moneymaker for Tesla. So if you add everything up, all the revenue, you get about $130 billion of revenue in 2025. And to calculate the gross profit of that revenue, I used a 24% gross margin percentage. Tesla usually falls between 20 and 25% gross margin. I think they target about a 25% gross margin, and they are going to get either 25% or very close to 25% because of their competitive advantage and their autopilot software. So I think a 24% gross margin percentage is pretty reasonable. So if you take 24% of the $129.8 billion, you get a gross profit of $31.2 billion. Then I subtracted what I think their operating expenses will be in 2025, their SG&A, which is their selling, general, and administrative, at $11 billion, and their R&D, research and development, at $5 billion. So if you just subtract that $16 billion from $31.2 billion, you get $15.6 billion. The way that I came up with their operating expenses is that I just took the total of their last 12 months of operating expenses, which is $4.2 billion, and I just applied a compounded annual growth rate of 30% through the year 2025. And if you do that, you get $16 billion. I wasn't completely sure on what percentage to use in terms of how quickly I think their operating expenses will grow. If you look at their past 4 years, their operating expenses have stayed pretty flat. And this is despite ramping up their Model 3, building a new factory in China, and starting to build a new factory in Berlin and Texas. Despite all those things, their operating expenses have stayed flat. Their operating expenses are going to go up as they build new factories, as they start manufacturing their own batteries and start developing their $25,000 car. I settled on a 30% growth rate per year. And if you use a 30% compounded annual growth rate for their operating expenses, then that equates to about a $16 billion operating expense for 2025. So, like I said, if you calculate everything, you get about a $15.6 billion of operating income. And for simplicity's sake, I'm just going to call this operating income earnings. I know more things go into earnings, like you have to subtract taxes and interest expense, but I'm also not counting any regulatory credits. I'm not counting any money made from Tesla Energy. So I'm just gonna say that all those things are gonna cancel out, and I'm just gonna call this line earnings. Now you have to do a judgment call on what you think the market will value a $15.6 billion earnings. And you would apply a earnings multiple to that $15.6 billion. I have some examples of some earnings multiples on the bottom here in the PE ratio. I just put some PE ratios and put their corresponding market caps on top of that, just to give you an idea of how certain PEs would correspond to market caps. If these things don't make sense to you, it's okay. I do explain these terms in another video in my stock market investing for beginners, and I'll put a link to it in the description below, and I'll put a link to it somewhere on the top right of this video. As you can see, the PE ratios are pretty high, but Tesla deserves a very high PE ratio because it's a high growth company. One way to analyze a high growth company, a lot of people use what is called the PEG ratio or the PEG ratio, where you take the PE and you divide it by their earnings growth rate. And this year, Tesla will make probably around $2 billion in earnings. So at $2 billion in 2020 and $15.6 billion in 2025, that's about a 50% compounded annual growth rate. So if you take a 50% growth rate, you'll see the corresponding PEG ratios below. If you read about the PEG ratio, you'll find that it's common knowledge that a PEG ratio of 1 is considered fair value. Anything higher than 1 is considered overvalue. Anything less than 1 is considered undervalue. But in this climate today, a PEG ratio of like 1.5 is probably considered fair value. Whether or not we think a 1.5 PEG ratio is fair value or not, or whether we think the market conditions will continue through 2025 is a separate discussion. But I think a PEG ratio of 1.4 is going to be pretty reasonable. Whether or not the market is optimistic at that point, the overall market is optimistic or pessimistic, a lot of people will think a 1.4 PEG ratio is a very good price for Tesla, especially considering that they will be in the early stages of ramping up their 25K electric vehicle. There's going to be so much hype around that car, and that car is going to have so much potential that a 1.4 PEG ratio is going to be a steal, and a lot of people will be willing to pay that. Sometimes it's not really about what you think is a fair value, it's what you think the market will think is a fair value. So I have 1.1 billion shares outstanding for 2025. Right now, they have a little bit over, I want to say 920 million shares outstanding. And I have it at 1.1 billion because there's going to be share dilution through capital raises and stock-based compensation. So I just have it at 1.1 billion. So if you take the market cap at 72.3 PE, the corresponding market cap would be 1.125 trillion, and you divide it by the shares outstanding, you would get a price per share of $1,023. So that's how I got my prediction for $1,000 price per share by the end of 2025. Let me know if you agree or disagree with my analysis. If you found this video helpful, give me a like, it'll really help this channel. If you want access to this spreadsheet, I can put it onto Google Sheets and share the link. So just let me know in the comments below. And if this is the first time you're watching one of my videos, I do videos on all sorts of topics revolving around money. So subscribe to my channel if you're interested in that and check out my other videos. Other than that, thanks for watching and I will see you in the next video.